Everyone is happy when the markets are up, but what happens when things go south? What if the market crashes again? In this video, I'll tell you how smart investors protect their money even when the headlines are screaming down. Hi, my name is Ola. Welcome to my channel and subscribe because we talk about money and how it affects your pocket and what you should be doing. So the first thing that smart investors do is they do not panic. It might be easier said than done, but what does panic mean in the context of investing? Panic means jumping to sell, right? You have an investment, it's already running and some news comes and you just jump and sell. That is what panic means. It doesn't mean that your heart is not shaking, you are not wondering, you're not questioning. It's actually that action of jumping up to sell. So smart investors do not panic. That is the first thing. Do not make emotional investment decisions. You have to separate the emotions from logic and analyze properly. Now, the reason they do not panic is because they actually they understand that the market is never static. It's either moving up or down. It's never just flat. And you really don't want the markets to be flat. You actually want it to be active, right? So in that definition of active, it involves going up and down, and smart investors understand that, so they do not panic when they see the news. Now, while you are not panicking, what do? You follow a plan, right? You assess the possible impacts on the company and what you would do if it drops beyond a certain level, right? The fact is, emotion is the worst enemy of long-term wealth. And strategy is your best form of defense, right? It's literally your best form of defense. So you need to stick with that. Now, the second thing that smart investors always do is diversify. I'm sure you've heard that so many times on this channel, but I'm not speaking English. The fact is that there's always something called economic cycles. What that means is that there'll be times when it'll be up, there'll be times when it'll be down. It's just normal. Why? Because there's some things that take it up, and when it gets to a certain level, everything must correct and rebalance, and that's that process of sending it down. Now, if you understand that, right, what happens is that some things thrive when the economy is down, and some things thrive when the economy is up. If you have a properly diversified portfolio, at no point in time will you not have something that is doing well, even if it is just the fixed income investments bringing you interests. Right? So smart investors do not put all their eggs in one basket. Now, for you are so confident, you are so sure it's a sure banker, blah, blah, blah. Have you ever woken up and the day the sun was shining, everything looked so beautiful, and then by the time it is 9 p.m. that day, you ask yourself, what just happened? The way your day just turned, and you were in shock. It can happen with money too. So the idea is that even if it happens with your money, you don't lose your shirt. What do I mean by that? It happens with money, you may lose some, but you don't lose everything. You don't have to start from ground zero again. That is what diversification does for you, and that's what smart investors understand and do. Why? Because there would always be ups and downs. There's no escaping it. There will always be ups and downs. Now, the third thing that smart investors is that they keep their emergency funds out of the market. Yes, I've had people put their school fees in cryptocurrency, or put their kids' school fees in cryptocurrency for a quick move, right? Or put their emergency funds, like their backup cash, in one deal that looks like it can never go wrong, and then it actually goes wrong. Now, let me even use the crypto example. The reality is that even if it goes down in previous times, it ends up coming back up, right? We agree. However, if you are pressed for cash, you need cash at the time you need it, so that there's a potential for Bitcoin to go back over 100K. It does not serve you at that point. That is why you keep the money that you need out of such markets, right? It's a discipline, and that's what smart investors do. They understand that they are going and they're growing and they want to make money and they want to build wealth, but the most important part of building wealth is sustainability. Now, if you are pressed for cash, and let's say, for example, you buy 2 Bitcoins at 70K, right? And then the prices go down to 50K and you need 80K. You'll be forced to sell those 2 Bitcoins and you'll be pained. Why? Because you need the 80K right? But if that money was not in Bitcoins, you will have your 70K and you just add 10K from somewhere and you keep it moving, if you get what I mean. Or you just tell the person, I have 70K, please give me some time, I will give you the balance. But that you would have to sell your precious 2 Bitcoins and then 2 days after some news comes out and it goes back to 100K. Can you feel the pain? Yeah. Why am I laughing? It's serious, right? So the major rule here is keep emergency, key funds, critical funds to your life out of the volatility of the market, out of the markets that are volatile. If at all you need to put it anywhere, put it in fixed income, boring investments where you'll be watching as it's adding $1 or 1 naira every day in peace. Don't do that. The next thing that smart investors do is that they see crashes as opportunity. And I'll ask you a simple question. So you see your Bugatti, you've been eyeing a Bugatti, you want to buy a Bugatti, you've been saving for it. And then a Bugatti costs, I'm not sure which one, I'm not sure, but don't quote me. Let's say Chiron costs $8 million, random number. And you have $5 million, and then you see that something happens and the Bugatti just offers it for $5 million, right? And it's from the Bugatti store. It's not like it's on one random website somewhere offering where you are not sure. It's actually from Bugatti. The question is, what would you do? Would you jump at it, or would you say, are they really sure that does the price change that it's a Bugatti, that you bought that 5 million, wherever that person put that 8 million? Does it change the fact that you are driving a Bugatti? It doesn't. That's the same thing with stocks. I legit do not understand when you find stocks on discounts and then people start running away. Excuse me, are you trying to buy expensive or cheap? Yeah? Does it change the fact that the company is good? Right? So you've been eyeing a good company. You've been saying, I want to buy these stocks. Or you have some of it and then something happens to the general markets and the price comes down. Then you start running away like everybody when you have been eyeing that stock. Excuse me, are you trying to buy expensive or trying to buy as cheap as possible for the same value? Think about it. Smart investors think like that. So you hear things like buy the dip, but buy the dip is not a general rule. It's a general rule specific to companies. How can I say general and specific? But yeah, it is specific to companies. The logic is buy the dip, but buy the dip of a company that is going somewhere. That's how smart investors work. So you don't run away from the market, you look for the opportunities. That's why you need to keep your emotions out of it. You need to keep that headline and however the dramatic journalist curated it so that your heart will skip a bit. You ignore that. And strategy. Use strategy to make your decisions. Yeah. Then the final thing, they understand that time in the market beats timing the market. This is something that a lot of people try to do, but I always ask one simple question. Are you a trader or you are an investor? If you don't really have time to track the market, if you are just a buy, wait for a bit and maybe exit, or you're building your portfolio, then you can't be timing the market. You have to give the market time. What do I mean by timing the market? You are looking, oh, we moved from $1 to 2. Oh, we moved from this to that, right? That will make you jump unnecessarily. And that is a trader's life. It is a valid life, but if you are not a trader, who is looking for that bid, who is looking for the most efficient broker, who charges the least fees, all those things. If you are not a trader doing technical analysis, using pricing to determine blah, 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 and you're a fundamental investor looking at a company and saying this company is going somewhere, then your time, that means you're waiting and ignoring the noise will benefit you more than the jumping and the ups and the downs of timing, the pricing. Is it a good time to buy? All that noise, right? And that is what smart investors know and they live by. The fact is this: you can never predict market crashes to the letter. While we understand and recognize that economic cycles generally take like a 10 to 12 or 8 to 12 year period for everything to go back again to that whole cycle of busts and bubbles, the fact is that you can't predict crashes. You can't predict who's doing what that's going to come into the news and will throw things off. You actually can't predict that. But what you can do is create a stable portfolio. And that's what smart investors do. They are more particular about sustainability than hype and noise. They are more driven by strategy than emotion. Yeah, does that sound familiar? And they build their knowledge base consistently. That is very important. That is actually what makes them smart investors. And they, based on strategy, not emotions, take decisive decisions and ignore the noise. Yeah. So I trust this was useful. So the goal is really not to avoid crashes, is to be unshaken when it happens, so that the next time somebody says, what if the market crashes? You tell the person, I have a plan. Yeah. How does that sound? If this was useful, please share with a friend, because this is such a major conversation. It is something that people say so much. And just to remind you that you can't outsource your health and your finances. You have to engage. If no one can go to the gym on your behalf and you'll be healthy, it's the same way you really can't outsource managing your finances to anyone. See you in the next video. Bye.